I'm starting off this conversation with a reference to the latest the latest memo that you wrote, wherein you talked about the sea change and how declining interest rates for nearly 4 decades being the second sea change, and the latest one being the complete reversal of the conditions from 2009 to 2021. How do you think this impacts 2023 and the years ahead, both for the Western world and subsequently the emerging market world?
Thank you. Well, first of all, a sea change, for those who don't know, is an idiom used to describe a major transformation, a total change. And I think not an occasional cyclical fluctuation, a major change. And I think we may be going through one of those. As you mentioned, the first one that I lived through occurred in the years between 1980 and 2020. In 1980, for those who don't remember, interest rates in the States reached over 20%. Paul Volcker became chairman of the Fed. He had to raise rates in order to snuff out inflation and inflationary thinking. Inflation is a real menace, and it has to be brought under control. And you do that by slowing the economy. So Volcker did that. As I say, I had a loan outstanding from a bank at the time. The rate on the loan hit 22 and a quarter in 1980. 40 years later, I was able to borrow at 2 and a quarter. So in other words, interest rates came down by 20%, or what we call 2,000 basis points. And this has been a very strong tailwind supporting asset ownership, subsidizing borrowers, enriching owners of assets, penalizing savers and lenders. And this prevailed for a very long time. And so long, in fact, that there are very few people around who saw the world before it began. You had to be in the 70s, which meant in our world, you had to be working in the 60s. You couldn't get a job in the 70s. So I got mine in the 60s, and there aren't many of us around. So this was a tremendous tailwind that benefited certain strategies and penalized others. And it had other effects, of course. It produces risk-taking, because very safe instruments like treasuries and cash yield close to zero. Nobody wants zero, so they have to go out the risk curve in order to get the kinds of returns they do want, and they have to take risk to get that. So that's one form. There were many ramifications. It was people were eager to do lending to risky companies, which meant made it very easy for risky companies to grow. That's another effect. So I think that I'm not calling for a return to 20% interest rates. Right now the Fed funds rate in the States is about 4 and a quarter, and I think it'll stay in this vicinity. It'll go a little higher next year. They've indicated that there will be some more rate rises, but nothing major. My main point is that it's not going back to what it used to be. To fight the global financial crisis, the Fed dropped the Fed funds rate to zero at the end of 2008 and kept it there for 7 years. So people start to think, oh, I guess zero is the normal interest rate. Well, the point is it's not. And when you have a very strong economy abetted by low interest rates, then you don't have defaults and bankruptcies. That's not normal. It's not normally so easy to raise money if you're a low quality company. That's not normal. So my point is that we're going back, in my opinion, to a normal times in which it's not so great for borrowers and asset owners, and it's not so bad for savers and lenders.